Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. What an interesting week we've had, and it does set markets up for an interesting future, of course. Okay, so I guess we have to consider the fact that for many people in the market, not so much ourselves, but for many people in the market, there's been a couple of big surprises this week. Remember when Janet Yellen spoke to Congress, and I immediately said, she has just cancelled the idea that it's all depositors in all US banks that are guaranteed. That's not the case. Well, the rest of the market didn't seem to recognize that. And so several days later, when she again made the same comments in a different arena, suddenly it was picked up by the media. And that was, of course, on the day of the Fed raising interest rates by 25 points again. Now, I had thought that there was a real chance they would pause, but they've gone the path of trying to keep people reassured by continuing to hike. And there's no doubt inflation is still way too high in the United States, and it is even reaccelerating. Well, it was before the banking crisis, and it is a banking crisis. There's far too many isolated specific circumstances, events of banks going down to suggest that there isn't a systemic problem. As I've mentioned before, the underlying cause of the systemic problem is that there are depositor withdrawals happening. And when depositors withdraw their funds from a US bank, the bank then is forced to sell bonds, which of course it may have bought at higher prices because interest rates are going up, bond prices are falling, which means that they realize losses. And if that becomes too extreme, they're obviously unable to handle that. So it's a forced realization of bond position losses on bank balance sheets. And with the collapse of Credit Suisse, we now have the added problem of the AT1 bonds being zeroed in that situation completely. So the owners of those bonds are seeking some legal remediation or legal action against the Swiss authorities to try and recover some of their money. But all of those bonds were just zeroed, leaving people who held them with absolutely nothing. Oh, and also don't forget, in the Swiss bank rescue, that 100 billion line of credit that was part of the deal where UBS purchased Credit Suisse for half where it closed on Friday, that was also a line of credit equally for UBS. So UBS was a little concerned too that it didn't want the effects flowing onto it, or it might have already been suffering some of the same fate. We don't really know. So that was a major rescue package. By the way, the Swiss authorities' rescue or support of the sale of Credit Suisse to UBS cost every Swiss citizen $13,500. So every Swiss citizen just spent $13,500 of their own money, via taxes of course, to rescue Credit Suisse. Quite a phenomenal outcome. And that's why some people say, is this a bigger problem? Because these are extreme measures indeed for that nation. Back to the USA. So we had Federal Reserve raising interest rates. I know this is old news by a couple of days, but I think the waters have cleared, the muddy waters have cleared a little bit, and we can now begin to think long term out of this. And what I'm about to say is not something a lot of people else are saying, and it's usually the case, thank goodness. So the Federal Reserve raised interest rates by 25 points and emphasized they are closely watching, the banking system, reassured people. Now, when a central banker gets up and says, or the head of Treasury, Janet Yellen, gets up and says, the banking system is sound, it's just standard central bank talk. They will say that even if there are 100 banks collapsing, they'd still say the overall system is sound because it's their job to reassure and produce stability and confidence in the system. So I wouldn't get too carried away with those comments. the Federal Reserve is concerned, obviously. It was part of the Federal Reserve FDIC Department of Treasury rescue of SVB, Signature, and other banks. The First Republic is still doubtful, by the way. It's not fully rescued as such yet. Hopefully it will be over the weekend. That might give markets a little bit of a push up on Monday. But what I'm talking about here is the overall structure of this crisis can in fact get worse from here. Because Janet Yellen has made it very clear it is personally up to her. She says it's in consultation with the FDIC and the Federal Reserve, which I'm sure it is. But if she makes the call that a specific bank's failure would represent a systemic risk, then that new program can come into effect, where the authorities take all the bank's best assets, their top-level bonds, all their best assets, and guarantee all depositors' funds, and all the investors in the bank just basically lose pretty much most of their money, if not all. So that's the program. And it's a kind of printing of money program to guarantee all depositors' funds in the case of a bank where its failure could be considered systemic risk. Now, it's up to her to decide what's systemic risk. So no wonder she thought so when it was Silicon Valley Bank, where all the very crucial to a government's PR and image in the world is really run out of Silicon Valley Bank and social media giants. So to support that industry was obviously a political as well as treasury banking move. So she's got this incredible power all of a sudden to decide which banks can fail the old-fashioned way and which banks she'll decide to rescue. So they have to be kind of banks too big to fail. And people can pretty much figure out which banks they are themselves, but they are all located in just 2 states. So across the entire union, there are only 2 states where such banks would exist, where this new program that all of the American people pay for would apply. And that is in New York and in California. So any bank outside of New York and California is vulnerable to being allowed to just crash the old-fashioned way. So if you're a depositor in regional America or any of the other states and you're banking with your local bank, you're going to be wondering, and you've got over $250,000 in deposits, but a lot of companies and individuals do. So why would you bank with a bank where your deposits won't be guaranteed, when with a few clicks and fill in a few forms, you could be banking with a bank where probably all of your deposit would be fully guaranteed by the federal government? That's a no-brainer. And it can actually, so this new reality, this new world of the banking system in the USA is such that it could actually, and I'm sure it is already having an impact on regional bank deposits, as depositors will, over coming weeks, just simply decide to move to one of the big banks. So if anything, this new program, as government intervention in any market often does, and has far more negative impacts than are designed, this new program actually highlights that you need to have your money with a big bank to be safe in California or in New York. But they have to be big enough that they can't be allowed to fail, or significant in some way that is politically of interest to Washington. So it's actually going to make the regional banking crisis a far more probable event. So the risk for regional banks has actually gone up several notches in the past few days. Now, it had gone up about a week ago when Janet Yellen first made those remarks, but the rest of the market, we did tell you, but the rest of the market didn't pick up on it, and it didn't become mainstream until after on the same day as the Fed raised rates and Janet Yellen spoke again. Now that it is mainstream, and I think it became mainstream on Wednesday, during the next week, people are going to be thinking about that more. Now, what happens in a banking crisis? Stocks collapse, but not just banking stocks, all stocks collapse. They collapse because a banking crisis just makes people, consumers, businesses totally stop spending, retreat. Some of them are having losses, but the fear and the uncertainty just that creates just really brings demand almost to a standstill usually. And that's not good for any company that's doing business in the United States. So the risk to the overall stock market has just gone up since Wednesday in New York. Well, it went up a little bit earlier, as I said, but it's gone up now. And it's only a few days that we've been in the minds of most people in the markets, that we've been in this new world reality, and everyone's trying not to think about it too much. Everyone's trying to think about, but isn't it good if it's a bank that could cause systemic risk, Janet Yellen will save the day and guarantee all depositors. So that means there's not going to be a banking crisis. But wait, and this is what the thinking will be next week. What about the other banks? What about the great majority of banks in the United States? I mean, we've had a list of 19 that have been precarious, and that's on top of SVB, Signature, First Republic. Bonds have had a bit of a bounce in recent days. If bond prices begin to fall again in the coming week, 2 weeks, regional banks could again be stressed, and a lot of depositors are smart enough to figure this out. And if they see bond yields rising again, bond prices falling, they're going to start pulling their money out of those regional banks. And then you have risk of contagion all over again, but far more profoundly now, because there is somewhere safe for depositors to run to. I mean, it's not that they'll have to pull their money out of the bank now and put it under the mattress. They can pull their money out of the bank and put it in the too big to fail bank. So it's greater motivation and impetus to actually get your money out of those regional banks. If I was a regional bank board at the moment, I'd be very concerned. This is a fundamental economic principle that is just running amok. And this intervention could really come back to bite Janet Yellen, the FDIC, and Chairman Powell in a big way. Now, while all of this risk is out there in the market, what we have is the Federal Reserve still raising interest rates, and it's the most aggressive interest rate period in the history of the Federal Reserve, and they're still raising rates, and they're still quantitatively tightening, and they're not slowing that down at all, though the bank rescues are a little bit of money printing. So, but their quantitative tightening program is still running strong. So we're left with an economy that had a bright moment, but may not be going that well right now. In fact, the bright moment was that it wasn't contracting. It was maybe stable, up a little bit. And that looks like it only lasted 1 or 2 months. So that's the economy that's already out there. Then it's hit by a banking crisis. Then it's hit by, oh no, there isn't really a banking crisis, its leaders say. But then people realize, no, but the new policies make things worse. And then we have Federal Reserve still raising interest rates and quantitatively tightening. Oh, it's a fantastic time to buy stocks. No, don't take that clip and edit that and publish that. That's not what I'm saying. This is highly problematic. Which is why that rally that was so odd, because it was just this false belief that the banking crisis is resolved. The radical action taken by the FDIC, the Department of Treasury, and the Federal Reserve, the radical action they took was really, it's never been done before. Not even in the GFC. And the radical action the Swiss authorities took, that was just on a whole nother level yet again. So what all this suggests is there are real problems out there that we do not know about. Because if there weren't any other real problems bubbling away out there in the financial system, they wouldn't be taking these desperate measures. I think we need to still be very careful about the potential for a much bigger banking crisis in the United States in particular, but also perhaps in Europe. Look at the demonstrations happening in France now. It's almost another revolution in France, and it's across all of France. I mean, one day the strikes and protests were across 200 towns and cities in France, and it's an ongoing situation there. Refineries are blockaded. France is in real serious political trouble at the moment, and it isn't just about the pension, which the Western press likes to talk about. It's also about NATO membership and the war with Ukraine and the sanctions. All of that thrown in is what these protests are about. We've seen huge, massive protests in Brussels, Netherlands, Germany, and other countries in Europe. So there is a lot of unrest in Europe, and in that environment, consumers and business expenditures will be pulled back. So Europe's also maybe at the end of its bright spot, and maybe we should consider the risk that there are other banks in Europe with a problem. Though it is possible they are isolated at Credit Suisse. It does actually have a specific experience and history, but the United States is still very much a big concern for me. In economic data in Asia today, we've seen in Japan that inflation dropped a full percentage point from a 41-year high of 4.3 to 3.3% inflation. And at the same time, manufacturing fell into contraction in Japan. Those services ticked up a little bit. The overall combined economic PMI, if you like, was slightly positive. But I think that probably means the Bank of Japan, the incoming governor of the Bank of Japan, is not going to set the world on fire with his first meeting of the BOJ by raising rates. So that means rates in Japan are probably still going to stay as they are. The economy simply does not have the traction, if you like, to justify rate hikes. Remember, they've been through a long period of subdued economic activity. They don't want to mess up any recovery that may be happening now by raising rates too soon. And with inflation coming off from 4.3 to 3.3, that's happy news, happy days to the Bank of Japan decision-making process. In Australia, we saw the Judo Bank manufacturing PMI fall into contraction. Now, I've been saying for a long time, Australia can have a recession this year, and it looks like it's on track to do just that. So there are problems all around the world in this economic resurgence sort of hope that it is moderating yet again. So I would suggest that the equity market is not an easy buy at the moment, because, as in an easy idea to buy, because there are significant historic level risks still at play. And that's why we saw that rally given up the previous days before Wednesday. And that's why the weeks ahead could very much see sideways to downside movement in Western equity markets. Because remember, most of the economic slowdown of the last 1 to 2 years has been Western economic driven. I know there were lockdowns in China, but Western economies were creating their own problems for themselves, and Western equity markets have been in serious trouble. And I do think there is a rebalancing of the world happening, which we're all aware of, and I've been speaking of for over a decade now, and that continues to happen. And that is that, the United States is falling back into a pack of other strong economies, and it is that there is really emerging markets don't use that word anymore. It maybe you use it for Africa, but I wouldn't use that word anymore for any country in Asia or any country in South America. Well, maybe it's a bit of a patchwork quilt in South America, but yeah. But certainly not in Asia. And I've been saying this for nearly a decade as well. It's just an incorrect term. A lot of, we're talking about young capitalist economies, not emerging markets. So that the rebalancing of the world is going to continue, and it's going to have a profound impact on where the world's freshly created new capital actually goes. At one stage, the United States used to draw in 71% of the fresh available investment capital in the world every year would go to the United States. It's halved, and it's likely to continue to decline. So where does that leave the US dollar? Probably badly exposed in a historic sense, but for the moment, the fact that the Federal Reserve is still raising interest rates is going to support that currency. And at the same time, if you look at the US dollar against the euro or the Australian dollar, both those currencies still have problems. In Europe, there's always the risk of a re-escalation or a continuing escalation, if you like, of the Ukraine conflict and the impact that has on consumer business sentiment. And in Australia, we have this geopolitical build-up of pressures, which probably is not as necessary as it is being at the moment. And so any further development along those lines on the geopolitical front in this part of the world is really bad for Australian stock market and the Australian dollar. So hopefully there's none of that. But I wouldn't trade the Australian markets without being aware of that potential. Overall, I'm glad I brought you so much cheery news to go into your weekend. But I do think we need to be mindful that there could be tremendous opportunity in the weeks ahead if you are a short seller of equity markets. Have a great day. Have a great weekend. All the best. Clifford, Bennett.